You have to understand all of these sellers, all these buyers are buying your company one way, and you as a seller operate your business another way.
Really important, I think, to have very clear corporate allocations and how you think about corporate expenses in your business, but more importantly, what you pull out from that corporate picture, because if you're kind of shooting from the hip.
Having somebody, an advisor or somebody that understands what is an acceptable normalization add back is critical, because at the end of the day, otherwise they're going to do the math for you. And when the buyer does the math for you, you're never going to come out ahead.
Unfortunately, your go-to real estate attorney is probably not the right person to get the deal done. So as I think about other deal killers, it could also be just having the wrong representation on the vendor side, especially on the legal side. All right, everybody, welcome back to another episode of Behind the Business with Amplify Capital Group. My name is Chris Jenks, and with me I have my partner, Jeff Pavone. Today, I want to talk about deal killers. So what actually takes transactions after the LOI? And, getting a deal and getting an LOI signed is one thing, but, at the end of the day, you don't dance until you're in the end zone, right? There's a lot of complexity that happens. And we often say, once we get an LOI, that's great. But the reality is that's when you really roll up your sleeves. That's where a lot of the, the difficulties in a transaction will arise as you kind of enter that stage of diligence. So today I want to talk a little bit more, provide a candid behind the scenes of, what are some of the common reasons why a transaction may fail between LOI and close, and maybe even broaden that a little bit more, talk a little bit more about why processes fail. So with that, let's jump into it, Jeff. In your assessment, what is the number one deal killer in a transaction?
So number one could be quality of earnings. So, when we get your financials, we're taking your financials and, we're running all of our ad backs and doing what we need to do internally. But you have to understand all of these sellers, all these buyers are buying your company one way, and you as a seller operate your business another way, right? So a seller operates it as a typical mom pop owner operator business, do what they want to do with their financials. A buyer on the flip side of it represents a partner. They represent limited partners, and they've got a fiduciary to make sure they know exactly what they're buying. So as soon as you get an LOI signed, they're going to buy your company a grand a number, and it's based on a certain amount of EBITDA. And so they will hire a third-party accounting firm to do a quality of earnings. So if that quality of earnings checks out, there's a good chance that deal is going to move forward and close. On the other hand, if a lot of what you put in your financials does not check out with quality of earnings, at that point you've got a moment of truth to say, okay, wow, we've got less income than what we represented. Now what do we do? And so that I would say would be a big concern. At Amplify, we've got a very, very strong back office team of analysts and VPs that have a lot of experience. Very rarely will this happen when we're digging in deep, but occasionally there are things that are out of our control that quality of earnings will dig up, because it wasn't, an example could be you didn't report a full month of rent or let's say a full couple months of chemistry cost. And if you're running a big enough company, all of a sudden that shows up that you've got $300,000 less profit than you said you did because you didn't pick up that expense. There's a real example of something that if it's missed, it's going to cost you some money. So all we can say is that the tighter the books, the better chance it gets through quality of earnings. I think you're a long way to getting a deal closed.
Yeah, I think weak financial discipline's by and large the biggest culprit there, right? But also too, as we think about it, we often talk a lot about, four-wall performance versus fully burdened. And just to level set there and provide some definitions, four-wall, as the name would suggest, is just the performance of that store, right, within those four walls, just that box. And what that does, that eliminates all the corporate expense. And generally speaking, when a strategic is looking at your business, they're going to underwrite it based on four-wall performance because they already have the scale of their corporate infrastructure to benefit from. That said, really important, I think, to have very clear corporate allocations and how you think about corporate expenses in your business, but more importantly, what you pull out from that corporate picture. Because if you're kind of shooting from the hip, you may have unclear corporate allocations in which it may not allow you to pass QOV, or it may allow for adjustments on behalf of the purchaser to adjust for, and ultimately, take a downward revision to EBITDA. But I think another thing to think about too is deferred repairs and maintenance, right? A lot of groups, they're kind of entering that stage of selling, that will show up in your books, right? So don't pull back on chem costs, don't pull back on maintenance just because you're getting ready to sell. That will be teased out in quality of earnings, and a group will be able to assess that profile of how you spend in your business historically versus where you're at present. So there's no hiding from that, right? The other thing that's related to financial reasons, but not necessarily quality of earnings, you have to keep in mind here, right? The diligence process will last every bit of 90 days. And if you are providing projections for your business or forecasts for how the year is going to play out, you have to ground that within reason. I think that is by and large one of the biggest areas to trip up for any group that's selling today. Is you're looking at your business, you're going to put together some just ridiculous growth assumptions for the year ahead to try to get as much credit as you can to boost your valuation. Over the course of the 90 days, the buyer will get readouts on how you're performing, and they're going to be looking at how you're tracking to those projections. And I think, Jeff, that's one area where we spend a lot of time when we're taking groups out to market, is really kicking the tires in those projections to make sure they're reasonable, to make sure they're defensible, but more importantly, to make sure that this is something where the business could actually hit. Because again, you're going to have a 90-day window here where a buyer's looking at the performance of your business, and they're going to see if those projections are real. So I think that's one cautionary area as well to ensure a greater outcome.
I think that's spot on. I think at the end of the day, when they sign that LOI, they will be tracking all your KPIs. They're going to be looking at how many cars you're washing, how you're targeting against your pro forma. All of a sudden, they see a drop off. That probably is, when we think through it, one of the real reasons somebody would walk out, right? If all of a sudden you're tracking at X amount of volume and it drops by 20% for some unknown reason, and they're saying, well, you'll say it's weather or something, but the fact is a car wash will open up across the street, right? So they're going to be looking at that and saying, at that point, they've got to underwrite it differently. The other real thing to try to understand is an operator negotiating with a private equity buyer alone is sort of really at a disadvantage, because there is what we call normalization. And so when you're looking at your numbers you're selling, you're going to give them a number, and they're going to give you an offer based on your number. The question is, there's certain add backs, and that can be normalized. And you may go to the extreme of saying we can operate with less labor than what's normal. They're going to start adding that back. It goes both ways, right? At the end of the day, if you're excessively high on chemicals and you can normalize it to market, we'll add that back. And so having somebody, an advisor or somebody that understands what is an acceptable normalization add back is critical, because at the end of the day, otherwise they're going to do the math for you. And when the buyer does the math for you, you're never going to come out ahead.
Another area as we think about some issues to address as you're in that stage through LOI diligence, to me, the real estate's always kind of a big question mark, right? It could be everything as simple from making sure your Alta surveys and your as-built are up to date, and that there's no encroachment utility easement, or it could be something like environmentals. To me, we're doing a lot more today, Jeff. I think a lot of it's just a byproduct of the geographies where we're seeing a lot of deal flow, specifically in the Northeast. But a lot of those car washes are, usually or most cases on ground leases or on leased real estate. And I think about leased properties. There's a lot more complexity with those deals, and making sure that you're prepared and understanding kind of, provisions around assignments of those leasehold obligations, making sure that, those memorandum of leases are recorded, making sure that, if you do need an estoppel for the purchaser, what is the landlord's obligation to respond to those estoppels? And generally speaking, anytime you open Pandora's box, that landlord will take that opportunity to take their pound of flesh. talk about the real estate side of things. I mean, to me, I just hit a few things that I see as being common issues here on the real estate side. But I mean, a lot of what is so attractive about car wash M&A is the fact that it is single-use real estate. A lot of times these are fee simple acquisitions in which that real estate comes along with the transaction. You agree with that? Probably real estate's number 2 on the list there behind financials.
Yeah, and for multiple reasons. One is just from an environmental standpoint. Two, it could be knowing who could be potentially building. So if somebody's going to pay you, $7, 8, 9, $10 million or more for an asset, you've got to know who's coming in your area. And so checking with the city about new permits is imperative. So I'd say, up front, you could get an offer that looks very attractive because they're buying it based on X risk. So when they look at making an offer to buy your company, the buyer, they're buying it assuming we're going to pay you this money, but we're not assuming your risk. So when the diligence process starts, let's assume they get through quality of earnings. They're basically now looking at saying, is there anything that's going to risk us hitting those numbers that you're selling us? And one of the biggest factors could be your real estate and who's coming in next to you.
Couldn't agree more. We often do a lot of market tours with potential buyers and find a great car wash location with a lot of emerging retail, but you find that one empty pad that's kitty corner there, and immediately the light bulb goes off where there is encroachment risk that could be possible there. That's an interesting one. Other things that I think about, too, as we talk about potential risks, I think vendor selection is a key one, specifically on the legal side, right? I think a lot of groups, they'll kind of call up their real estate attorney that's helped them put together their land deals, and they want them to represent them through an M&A transaction. If you are thinking about selling or if you're in the process of selling today, I cannot tell you how important it is to make sure you have the right legal representation, especially as some of these deals become more and more complex, right? Whether there be a seller financing component, whether there be deferrals, reps and warranties. I mean, there are a lot of things that you should be thinking about that are specific to the transaction. And at the end of the day, unfortunately, your go-to real estate attorney is probably not the right person to get the deal done. So as I think about other deal killers, it could also be just having the wrong representation on the vendor side, especially on the legal side.
Yeah, I think when you look at things that can kill a deal, having the wrong legal advice, again, coming at it from a real estate perspective, we've seen too many of those deals drag out, and that ends poorly. When you look at the buying side of it, you got to say the buyer is going to have one of the top law firms in the country, and they're going to have M&A attorneys sitting on the other side. You need to have somebody who speaks that speak, right? So when we look at most of the deals we're involved in today, I'm going to tell you, even small ones, they can have 10 to 50 people on their team doing diligence in one respect or another. So for us, at least, the amount of energy and effort going behind the diligence of getting a deal closed is enormous. And so the best help we can have is going to have a seller who's got the right team in place. Even from an accounting standpoint, having a CPA that did your, financial is different than having somebody who's going to give you advice on allocation and tax consideration post-sale. So you're going into this thing as educated as possible. Now, too many guys look at this thing and saying, I don't want to spend, let's say, $200,000 on a lawyer. It's really expensive. The most expense you can have is a failed deal. Two is a bad deal, which is even worse. And so having a team that is sophisticated enough to deal with the other side's legal and tax is going to be critical.
Yeah, you get what you pay for there. And I think, we're doing a lot of talk about what could go wrong, but I think what solves a lot of this is just, again, having the right representation and knowing that the right experts and domain experts to pull in to help you solve these problems. Whereas we talk about QOV, I think a lot of it goes into kind of our pre-marketing work that we do on the Amplify side. I think one thing that's interesting when we take a deal to market, we're literally going to look at it from the buyer lens, right? We know how buyers look at these deals. We're going to put our critical hats on. We're going to kick the tires on as if we're underwriting the deal for our own personal investment. And I think, again, a lot of the issues that can arise from that LOI through closing stage could be solved by just making sure that you're putting together the right roster and the right team behind it to get you through the transaction. On that, I think, another area where things could go awry is, financing risk, specifically financing on behalf of the buyer, right? And I think from our standpoint, we have a good understanding of who's out there, who's real, and how the cap stack behind them is formed to make sure that we're putting together deal terms that not just reflect the best interest of the client we're representing, but also the best chance of a successful outcome here. And I think having that understanding of who's on the other side of the table, their ability to get to the closing table and see the transaction through successfully is going to be an important one here.
So I would say that's probably one of our more important roles, right? At the end of the day, we see new groups all the time that come out of nowhere and will offer something way out of market for buying your car washes. And we're doing simple math. We're sitting here saying, okay, let's say they give you $40 million for something that's generating $4 million of EBITDA. Their cost of capital is still going to be close to 10%, right? So if they're offering you 60 million, we just know that math's not going to work. From a financing standpoint, the underwriting from the credit providing the capital to close on that deal are very well educated. There's the car wash business today is a mature market with having real data on how to underwrite this business, and so we've got to make sure from our side of it, we're double, triple checking to make sure that whoever that buyer is has, forget how big they are. They've got to have a line of credit that's still available to close on a deal. They've also got to, they've got to have, it's got to be within range that we know the deal makes sense. But I'll tell you, Chris, the other key piece that we do on financing is at Amplify, we run a process, right? And so we're really, really careful about bringing multiple buyers to the table. And so we have a backup plan. And when you are a seller going all out with one buyer and that buyer can't perform, you sort of just spent a lot of time, energy. Your team could be involved in this transaction and you're emotionally fried in this thing. Having a backup buyer sitting in the wings keeps that buyer honest, and the likelihood that deal closes goes way up, and closing under the terms that you negotiated.
Could not agree more. I think that's one of the things you mentioned, process too. I think that's important that you have a group that maintains structure and discipline on how to manage the process, specifically keeping groups accountable to timelines. I'll tell you right now, one of the biggest deal killers, that's not a functional aspect of diligence, but it's just time in itself, right? Time kills deals. And making sure that you're keeping things to a structured timeline, you're keeping groups accountable, and you're keeping your arms around just the rapid fire back and forth questioning across the domains of operational, legal, financial due diligence is so critically important. I'm telling you right now, you can't have a business broker run a low to middle market M&A process and have a successful outcome, because that back end management is so critically important to make sure things don't go south in a deal. So interesting here, as we talk about stats around deal failures, did a little research in my assistant here, ChatGPT. Lower middle market, 70 to 90% failure rate going from LOI to close here. So I think that's, I'd have to say that's not our success rate. We're much higher in that form, but I think, again, highlighting and understanding kind of some of these areas where deals could go south, it's pretty important to make sure that you're prepared. On that topic, Jeff, what are some things you'd recommend for groups to prepare to kind of avoid some of these common pitfalls or blind spots in a process post-LOI to get to the finish line? Yeah,
so, one thing is to focus on what they want the outcome to look like, right? So for us, everybody talks about price. Somebody can say, we're going to give you X dollars, and you're going to get all excited, and you sort of take your eyes off the rest of the terms and other things. So I would say, make sure that you're focused on the right outcome, which includes price, terms, and even culture, right? It's got to fit within. You built this company, and the average, I would say, majority of operators tell me the thing they worry about most is their employees, because they love their employees and they love their customers. So being able to interview multiple buyers is a perfect way to go put a transaction on. So I would say the first step is making sure you understand that negotiating the price is gets you maybe 25% of the way there. It's that next 75%, having experience of knowing what you need to do to get this thing over the goal line. And I think, Chris, the advice about having the proper team lined up immediately, not waiting, making sure that the terms are negotiated up front, so this doesn't drag on and all of a sudden become a complete time suck. Making sure the buyer's got the proper capital to close on a deal, and it's got to make sense. So I would say getting that proper advice on the next 75% is as critical as the first 25%. And there's just other smaller things. It could be, when they're wanting to do diligence, a buyer wants to do diligence, letting confidentiality amongst third parties. We've seen deals blow up, having third parties walk on a site, do things. All of a sudden, all the employees know. Now you got disruption in your company, and the goal has to be is the getting your deal done with the best price, best terms, but doing it as confidential as possible, so there's no disruption in your business. All that's easier said than done, because there's a lot of gotchas in that, and what I'm saying, but for us, it becomes really running a very strict playbook and keeping real discipline around that buyer, so they're just not running you over.
That is number one on my list. Is I think about kind of the three levers that you could pull to prepare yourself and better manage to a successful outcome post LOI. Buyer selection is definitely, I think, number one on the list. General just preparation before you run the process is important. Then again, controlling the diligence process itself. I mean, I think the practical playbook here, if you're anybody that's looking to sell, to help yourself kind of throughout that process to ensure that you get the deal done here. I mean, again, one thing that we talked about, Jeff, is finding that right group that could pre-underwrite the business before you even go to market, right? Have the right representation that could look at it from the buyer lens. One thing we didn't talk about, though, to also highly recommend, I mean, if you have a deal of size, it's probably worth kind of doing a sell side Q of E. If justified here, just to make sure you can do your own internal quality of earnings exercise, to potentially clean up the books for any shortcomings before you actually get to that point of having LOI. Super important. But also, too, as we talk about the advisor, and the brokerage networks out there, setting valuation expectations early and honestly is so important. You have to calibrate. I mean, one thing that can throw a deal sideways is just a complete misalignment between bid and ask on the buyer and seller. And if you get to a point where you get a buyer to lean in on a deal that may not necessarily meet expectations, they're going to be that much more stringent as they go through the diligence process. So I do think one thing that we could do on the fringes, making sure that you're setting those valuation expectations reasonably and having frank and honest dialogue about what a business is worth. Because if you have a buyer going in with unrealistic expectations, that can be a recipe for disaster as you move throughout the process here, because you're going to have a buyer on the other end that's not going to feel good about the deal.
So it's managing that diligence team. So when you look at, our team, for instance, our back end team is probably bigger than our front end team, right? For a reason. When you look at getting an LOI and starting diligence, you're going to have a quality of earnings. So you'll have an accounting firm with, I don't know, five or more people who are going to be digging into your financials. You'll have legal diligence. You'll have a law firm specifically hired to do all your legal diligence. Separate from that, you'll have a real estate diligence going on. You'll have an insurance diligence going on. So you'll have an HR diligence going on. And so the question from an owner standpoint, this is where we get heavily involved. We manage that diligence side internal with our team. We're the front line of the calls, keeping those requests to an absolute what is a must have versus what is just an ask, and then communicating with the owners of saying, here's what we need, here's what we don't need. So you're not sitting there answering 100 questions that you don't need to answer. So that's I would say really important to have is who's managing from your side all of those different disciplines that seller's going to demand.
That was literally the next answer. You took the words out of my mouth there, Jeff. The best way to control the process by having structure and have that team there. I mean, having data rooms with that are defined and built well, response protocol in place. That way you kind of go, one thing that we'll do is, if a buyer is asking for information and we're working with the seller, we'll kind of have a staging room just to make sure that we're reviewing all the data and making sure that we're sufficiently answering the questions being asked. But I think, having owners over work streams, using data rooms, and having that process and having that team in the back end is probably the next biggest thing for sure.
The one thing I would say in wrapping up is going to be the one thing is in today's world you're seeing deals. Some of them are all cash, but some of their structure. Not all structure is the same, and so having an experience on that side of it, we try to shy away from earnouts, but there's a way to get guaranteed cash payments. Where experience matters is how do you protect your interest in making sure that you have ironclad quality guarantee behind whatever you're going to defer and that deferred payment. That's a whole nother level of I would say things to make sure you're keeping an eye on, because and the bigger the deal, the likelihood that there's some sort of structure to making a deal work is going to happen. But making sure you're protected in every which way is critical to how you navigate that.
Yeah, I mean, the devils are in the details, right? An earnout is a very generic statement here, and how you actually go about the process of defining the earnout, what metrics are hit, revenue versus EBITDA-based earnouts, two totally different risk profiles for a seller. As we talk about deferred payments, do you put it simply as just a cash deferred, or do you potentially structure it more as a seller financing component where you could tack on some interest and even potentially securitize that note by putting a first lien position on the operating assets? And to your point, Jeff, in any environment in which capital markets show any form of stress, structure becomes more evident in deal making, especially to get to valuation expectations for the seller. So I think that right representation to think through all the gaps in that could be presented with structure in a deal, that's critically important.
I appreciate the time today.
So with that, thank you for joining us in our podcast Behind the Business. Really hope you enjoyed it. If you want any additional information, please go ahead and visit us at amplifycapgroup.com.